Yo, what's up, everybody? It is Wednesday, October 29th. I just got back from Wednesday night sparring session. I do 2 spar sessions a week, Wednesday and Friday, and they're always a lot of fun. All right, so we had the rate cut today that was expected, and also Powell did his usual thing, which was just to smash down any further rate cut expectation. The guy's incredible. Like every single time, it's so predictable. We get the Fed decision, which is the rate cut, and then you absolutely know that he's going to go into the press conference and he's going to smash down any expectation of further rate cuts. So, that's what was blamed for the market turning around and going down. Dow, I think Dow was down, S&P I think was down, NASDAQ was up a little bit, but it gave back most of its gain, a lot of its gains. I'm telling you now that the fiscal situation is deteriorating. I said that yesterday in my video. The data, today's data, which was actually, yesterday's Treasury statement, that showed another drop in that year-over-year differential in leading fiscal flows. It's very important. Remember, I've been saying up until yesterday that as long as leading flows, because remember, I was telling you guys that net government transfers, they're already down like 62.5 billion compared to last year. That's the water level in the swimming pool. And they're probably down more than that now. I'll update it on Friday. But now the flow rate coming out of the pipe, think of the swimming pool, think of the water coming out of the pipe into the pool, the water that keeps the pool full. There's a leak. That leak is draining out slowly, maybe even not so slowly. That's net government transfers, is the quantity, the volume of water in the pool, that's going down. But now the flow rate of the water coming out of that pipe, that's going down, that's dropping too. So now we're down 8 billion, and this, I can say with confidence, this is now a trend, a negative trend where leading flows are dropping relative to last year. That's not good. Now, I blame that on the government shutdown. When that's resolved, I hope we get back to a flow rate above last year, or at least equal to last year. But we cannot have the two things happening. We cannot have the flow rate, leading flows dropping down below last year's levels, and at the same time, net government transfers dropping down below last year's levels. And that is exactly what's happening. So even though Powell, he smashed down expectations of further rate cuts at the press conference today, I would say the real underlying cause is this fiscal weakness that is now developing that's not good for risk assets. What are risk assets? Stocks, gold, silver, most commodities, okay? Although Trump just did a deal with China for soybeans, so the commodities sector, you really have to look at that in, each particular market. If there's anything, for example, like the trade deal we did with the soybeans. But in general, risk assets right now with this drop in the fiscal situation, that is not a good environment for risk assets. What is a good environment? Treasuries, fixed income, utilities, stuff like that. Now, some of you, I had some subscribers today. I think even there were some comments here that maybe I saw them, maybe I didn't. That, one of my favorite guys, Jeffrey Gundlach, was on CNBC saying that, the outlook for further rate cuts is dimming, is going down. I am completely in the opposite camp on that. I think with these fiscal flows dropping, and if this continues, and we don't know even if the shutdown gets resolved. I don't know. Like, we got to see what happens. And when that thing hopefully gets resolved soon, I got to have, at least a week's worth of data to take a look at if that thing is bouncing back or not. But this view that we're done with the rate cuts, and by the way, that's kind of like what Powell was putting out there today. Like, don't get all excited about more rate cuts. That's kind of like a high bar to overcome. I see that as totally the opposite. And I think the forecast that I made a month or two ago, where I said that the tariffs were going to lead to firms looking for ways to offset the cost of the tariffs. And I said that was going to manifest in two ways. Number one, layoffs. They're going to try to squeeze more productivity out of a smaller, labor force. And that's happening, okay? And number two, the rollout, the implementation of artificial intelligence, of AI. And it's the labor factor, the labor environment, which Powell himself, he made that the focal point. If you remember the Jackson Hole conference back in August, and that was a big deal. I mean, we had a huge rally on the day when he made his speech. It was a Friday in August. I forget the exact date, but he said, now the Fed is basically going to pivot from an inflation decision-making, paradigm to looking at the labor market. So if the Fed is now focused on the labor market, and the labor market is going to be deteriorating as firms continue to look for ways to cut costs to offset the tariffs, that to me, right there, 100%, it says that we're going to see more rate cuts. We're definitely going to see more rate cuts, which means treasuries, that's what you want to be in. And I keep telling you guys, that is when you're talking about what is an attractive trade right now, what is an attractive thing to get into that not a lot of people are paying attention to, that still represents kind of the low-hanging fruit in terms of risk-reward, I'm saying it's treasuries, all right? Because there are going to be more rate cuts. And I've been right about this whole bond move now for, it's taken a long time, but I'm not a day trader. I mean, my whole thing that I talk about here is the macro perspective. That's what I did a video like a few weeks ago, because I had a guy saying, well, your report is so great and the information is so great, but I'm not into trading. I've been sitting with this position for almost a year now. I've been talking about this, the treasury market, TLT, bonds, Fed rate cuts that are going to be happening, the slowdown in the fiscal. I've been talking about that for a year. So I don't know what he's talking about. I'm not into trading. I don't do that. It's a macroeconomic perspective. That's what I talk about, as well as the other things, the psychological, the mental game, the understandings of MMT, all that other stuff. So anyway, that's about it for now. The market is going to be I don't see a lot of upside for the market right now. Again, let me repeat, when the government shutdown is resolved, hopefully, we'll need to see if the leading flows start to pick back up again. I'm sure they're going to pick back up to some degree. Absolutely. Because things, there are things in there that are not getting paid. There's withdrawals that are not being made. But we got to see. But right now, in the current environment that we're at, where leading flows are dropping and net transfers are dropping, that is not a bullish environment for risk assets. I'm saying that unequivocally, okay? So I'm not, hemming and hawing about or being kind of flip-flopping or two ways on that. I'm telling you right now, with those conditions, that is not a bullish environment for risk assets. Anyway, that's it for tonight. I'm going to go make myself some dinner. Thank you for watching. Please like and subscribe. It helps the channel. It helps the viewership. And don't forget to go to my website, pitbulleconomics.com. Sign up for a 30-day free trial to MMT Trader. Have a good night. Bye.